Hello, everyone, and welcome to LPL Market Signals. Jeff Bookbinder here with Christian Kerr. It is Cinco de Mayo, May 5th, 2025. Hope all of you are doing well and are going to go celebrate the holiday, which I guess is a little bit of a made-up holiday. But hey, it's fun anyway, right, Christian? How are you celebrating?
Maybe some mezcal later, Jeff.
That sounds good. That sounds good. I'll have to partake too to celebrate that and my brother's birthday today. So it's a little after 12 East Coast time as we're recording this on the 5th. Here's our agenda for today. We're going to recap the markets last week. Probably the most exciting thing to start on a positive note is that the S&P 500 was up 9 straight days, and we're actually trying to get to 10. It's going to be tough, but it's within striking distance here intraday. Next, Christian, you've pulled about what is it, four charts to 4 or 5 charts to sort of walk through where we are after the rally. It's a global perspective, so we'll I think the message is going to come out of that is that which we've been saying, we're not out of the woods yet, and the next leg up is going to be tougher certainly than the last leg. Next, the weekly market commentary this week is on municipal bonds. So even though I'm an equity guy, I guess, Christian, you have a little more of a bond background than I have. We're going to try our best to walk through the value of municipal bonds. This piece was written by Lawrence Gillum, our chief fixed income strategist. And then we'll finish up with a quick preview of the week ahead, which is really going to be the Fed and earnings, while we continue to wait for trade deals, which, according to the White House, coming potentially this week. The market seems to be comfortable with this wait and see because we've made a lot of progress off the lows. All right, so last week, Chris, I think it was really three things that drove stocks higher. We were up almost 3%. You had trade deal optimism. We haven't gotten any deals, but we've got trade deal optimism. Related to that is talk from President Trump about cutting China tariffs and starting talks. Then you had a good jobs report on Friday, and you've had pretty good earnings results so far. Would you add to that list? What are your thoughts on the market strength last week?
Yeah, I think it's fair. I mean, I think since we, had the 90-day reprieve, markets have essentially kind of viewed things a lot more optimistically, just because, they see pathways to get off kind of the way we were going. So, I think the markets just think we've maybe kind of reached peak negativity. So anything that we get now, it's kind of being viewed from a lens of, well, it's not as bad as it was, and we're kind of making our way back towards something more normal. So I think everything you kind of mentioned fits into that kind of lens that we've had over the last 3 weeks. But basically, if you look at things like the uncertainty index, we basically peaked a few weeks ago. So I think it's just that kind of overarching thing is really what's been driving the market higher here the last few weeks.
Yeah, we don't know where tariffs are going, but I think the market is comfortable pricing in a better worst case scenario than what it saw a few weeks ago. And coming from oversold levels, that's been enough. The this is our first podcast in May, or since the end of April, and it was actually one of the biggest monthly reversals ever. We were within about 3/4 of a point away from reversing a 10% intra-month low. That's never been done before in the history of the S&P. I don't even think it's been done by the S&P 90 pre-1957. So we were close, but actually the NASDAQ did that. The NASDAQ was down over 10 and ended the month higher. And we've completely erased all those losses. So really nice from April 2nd. So a really nice comeback. It's been led by the sectors that led the way down and the sectors that are hit hard, or some of them that are hit hard by tariffs. So you've got technology a leader last week. You've got industrials a leader last week. Communication services as well. I think the only maybe sector that doesn't fit this pattern is energy, because energy led the way down, but it has has also struggled on the way back up again. And Christian, that seems to be about OPEC supply pressuring oil prices.
Yeah, I think there's that. There's also, in terms of earning revisions, they've revised kind of the most downward as well. So I think that's put a little bit of pressure on the sector, at least from an equity standpoint. But in terms of what we've seen, and you want to talk about impressive, it's been things like on the international side, given the reversal we had last month. The DAX is basically within striking distance of new all-time highs, right? So we've rallied 26% off those lows, to where, like we're very close to a new all-time high breakout in some of these international indices, which I think is very telling in terms of kind of a bigger picture what's going on. But very, very impressive price action. Some of these foreign indices where it's doing quite a bit better than the S&P.
Yeah, good point. Clearly pricing in a pretty optimistic trade scenario whenever that comes. So here's the bond market and commodities and currencies. So here, yields have ticked higher. They ticked higher last week. They're ticking higher a little bit today. I mean, we do have the Fed meeting this week. I don't think that Fed views have changed a ton lately, but we did maybe unwind a little bit of cuts after the jobs report on Friday. So I think that's part of this. And then there's probably some tariff expectations here that are slightly increasing the risk of stagflation. That, of course, is Treasury negative. What are you seeing, Christian, either on bonds or, well, commodities, currencies? I think you have to talk about currencies
Yeah.
every week.
Yeah. Yeah, I mean, on bonds, we got some pretty big re-steepening last week, led by the long end after that quarterly Treasury refinancing announcement. So that's somewhat interesting. And in currency land, Friday we got basically a three sigma event in the Taiwan dollar, which is not here, but that ties in the bonds as well because their life insurance companies in Taiwan are big buyers of treasuries, and a lot of that's been unhedged. So essentially it's a managed float, and it got a little bit out of hand on Friday, to where essentially we're starting to see those life insurance companies have to start hedging their exposure, so bring up their hedge ratios. Kind of the more dire scenario is that if this were to get out a little bit more out of hand, then they would be forced to actually sell treasuries, which would put yields higher. Doesn't seem like we're quite there yet, but that's certainly been kind of the big news over the weekend, has been trying to understand kind of what's going on with that dynamic, and whether that spreads to other places in the region. Korea has a very similar profile in terms of foreign assets that they hold, a little bit in Singapore as well. So that's kind of been one of the more nuanced things happening in the currency macro world the last few days.
Yeah, I saw the Taiwan dollar at its biggest intraday move in 3 decades. So that tells you how unusual that is. And that it's actually meaningful. We don't talk about Taiwanese currency reserves or treasure holdings very much. We're always talking about China and Japan, but the numbers aren't small. So that is certainly something we'll have to follow. My question on that, Christian, is does that potentially give the US more leverage in discussions around China, or does it work the other way? I mean, it seems like what we're doing is putting more pressure on Taiwan.
Yeah, that was kind of the talk. There were a few interesting reasons people were giving as to why it happened. Some are saying that it might have just been an accident, like along a fat finger. Others are saying that it was part of some sort of potential trade negotiation, as the U.S. generally wants you know currencies to trade stronger versus the dollar. Um, it's tough to know right now, quite frankly. I mean, I do think the fact that it is a managed float, right? So somewhat manipulated, so it can trade freely, but within a band. I think the fact that we saw such a big move, suggests that something's going on. I don't necessarily think it was intentional. Like I said, a lot of times the simplest answer is the answer. And I just think the fact that, over the last few years, we've had this kind of U.S. exceptions in trade. You've had kind of their institutional uh, system there wanting to earn the extra carry on treasuries, so they were doing it unhedged. I think that's probably the real reason, and you start to see the move in the currency, and the natural next move or reaction to that is to up your hedges, right? And I think that's what we're seeing. I don't think it's a huge problem just yet, but I would be if they start actually selling the underlying assets, which seems a ways away, but something to just keep an eye on. Watch that currency. Kind of a little closer than you might have, because it could have implications for the bond market here if it does start to get a little bit out of hand.
Yeah, it's certainly not as big as the yen carry trade, and the way that translates back here is you're right, through the treasury market, probably more than anything else. Most people aren't out there trading currencies in Taiwan, at least not in the circles that we run in. So, but thanks for that, Christian. Good stuff. So let's move on. Where we stand after the rally, a global perspective. Maybe you have a common like thread here as we go through these
Yeah.
charts, but they're really I think collectively they give us a good feel for where we are. So we'll start with the NASDAQ 100 here, which is facing resistance. So is the S&P 500. 5,700 range is going to be difficult to break through. And I think you can say the same thing about the way this chart sets up for the NASDAQ.
Yeah, I mean, listen, we've had what, a 22% move in the Nasdaq 100, over the last 3 weeks, as you mentioned, kind of the longest streak in basically 2 decades. And that's put us into some pretty big levels where the bears are going to say, this is kind of where the rubber meets the road, whether we're going to get a reversal here or not. And I just kind of flagged a few key levels kind of in that white box, but basically, that yellow line is a 200-day moving average. It started to slope lower, so after going so deeply below it, and when you come back and retest it, you'd expect to see kind of a little bit of resistance. It's actually kind of where we peaked on Friday, so that's a big level. And then those lows from the beginning of the year, support could turn into resistance. That's another kind of big level. And then lastly, we talked about this kind of in the S&P, kind of where we peaked out, this idea of a measured move. So basically the move from 2020 to 2022, you take that move and then you kind of forecast it forward from the 22 low that got us kind of roughly where the S&P peaked. You can do the same thing on shorter time frames and at smaller levels, and the same thing kind of comes into play here, right around the 200-day moving average in the Nasdaq and the S&P. So call it, that 20,200 to about 20,500 is kind of a big resistance level where, given how fast this move was, you'd expect there, at least a little bit of stalling out. But if we can get through here and ideally see this turn into support, from above. So, kind of break through that 20,500 level in the NDX and then kind of come back down and hold it. That would be a really big positive and suggest, we could probably go back to all-time highs again here pretty quick. So, all I want to really highlight here is that we're at a big inflection point for the chartists. And a lot of the times these things are somewhat self-fulfilling, so everyone knows this is kind of a big level. So expect there to be this to be kind of a somewhat important week for the market, just because we are at such a big level after we've had such a big rally. A lot of investing, trading is observation. So observing how we react around here, I think, is going to be really significant from a medium-term picture.
Yeah, so I mentioned that the S&P didn't quite reverse the intra-month losses in April, but the NASDAQ did. It was the third best intra-month recovery in the history of the NASDAQ 100. That is, that's a big deal. And if you look at historical patterns like this, you're talking about like 87. I've seen studies. 87 looks a little like this. 2011 looks a little like this. 1998 looks a little like this. Some of these really sharp down moves that rebound quickly tend to resolve higher. So if you just follow the historical pattern here, you'd say this market should be up, another 10% over the next 12 months, maybe more. And we'll see. That's certainly more than possible.
Yeah, I
But
mean
that's
the
just
other
a
thing to point out would
man-made,
be the
yeah, it's a man-made problem. Obviously, it's tariffs, and so we'll just have to wait and see what Trump says.
yeah, yeah. And I just point out, we've had Adam Turnquist, our chief technical analyst, did some work on it, but it's not unusual after you get those kind of that waterfall decline we had in April post, the tariff announcement that you kind of turn into a wide, choppy range before you end up kind of really resuming an uptrend.
Mhm.
So, you know, these levels in the NDX, is this the top of the range? That's kind of the big question mark for the markets because we could easily kind of go back towards the middle of the range fairly quickly if it does hold a resistance. So that's what we're trying to figure out. Is this more of a V bottom or is it more of kind of a range trading bottom? Do we have another leg down? These are all the things we're trying to figure out. And like I said, I think this week's going to be pretty important one way or another from a technical perspective.
Yeah, no doubt. And we still want to wait and see how the fundamentals play out, but the technicals sure look really interesting here. So next, this chart shows ownership by these different segments, I guess, of the investment population that we can track. Christian, so what's the key message here?
Yeah, I mean it's the total combined U.S. equity position among all basic major investment types. So basically we're looking at exposure across mutual funds, hedge funds, vol targeting strategies, systematics, and even self-directed retail. And it's a Z-score, so it measures the number of standard deviations that we are away from kind of the mean value. And we can see the stocks are still very underowned even after the big rally over the last 3 weeks. And we closely watch positioning just because so often markets are more about what institutional participants are forced to do, not necessarily what they want to do. So it's that so-called pain trade, and there's plenty of potential pain for the institutional investor community at large if this market keeps going, because you can see on this chart, we basically at -2 standard deviations in terms of positioning. So they aren't as close to benchmark as they'd like to be. So that tends to hurt if we continue to see a rally. And I think this chart really explains a lot. And again, why we look at positioning is it does kind of tell you, uh, where, how people are prepared or kind of sitting for moves in the market and kind of what forces them to react. But market basically peaked out in early December. If you look at like the NDX, it did. The New York Stock Exchange Composite Index peaked in December, and then we end up getting kind of the secondary high in the all-time high in the S&P. But if you look at this chart, we were kind of the other way in terms of positioning, where we had kind of max exposure to the market. And then kind of as we got the DeepSeek news, international started to invest less in the US. And then that got, basically accelerated with the news from the tariffs. And we saw kind of that de-risking to the point where the markets now, or the participants in the market aren't as heavily exposed as they were. So you could make the case that this is a pretty bullish setup. And again, I think we can get through that resistance that we talked about in that last chart. Just given how under-owned equities are by and large, there's fuel for this move to continue. Just given that de-risking exercise we went through in April, most participants outside of retail are basically near levels where they may be forced to buy stock here if the rally continues.
Yeah, so this begs the question of what's driven the rally off the lows. Because, I mean, I'm sure you're getting machines buying on technical developments, but that's probably not enough to move this market as much as it's moved. I know retail's been resilient. How would you respond to that? What's driving
Yeah,
this?
I mean, we closely watch retail, but the fact of the matter is they're not a very big overall participant in terms of size. I think a lot of what's driven it is in early April when we got the tariff announcement, we kind of had the big de-risking. Liquidity essentially, collapsed, right? Across markets. As if you look at things like the bid-ask spread in the S&P futures, the amount available to buy or sell or move S&P futures was basically at decade extremes on the downside. So I think kind of that we've seen this big rally. It's been because we came off of levels where there wasn't much liquidity. So it doesn't take much, the same way it didn't take much to move the market down because of lack of liquidity. it doesn't take much to move it back up in a lower liquid environment. So as we get back to more normal levels of liquidity, it gets harder to move the market from a percentage standpoint as much. But I think kind of, you know, call it April 7th onward, since this rally kind of started, there hasn't been as much liquidity as there has been. And it's kind of easier to move, to have impact on the market with lesser amounts. So I think that's part of the story. And there obviously has been some kind of forced buying back, but I know like the hedge funds were pretty short into this, so a little bit of buying back here and there, but I think by and large it's a story about liquidity or lack thereof, that's helped drive it. But like I said, if we get through kind of those levels and it starts to look more and more like a bull market resumption, and the fact that the majority of these investor types that run a lot of money aren't as positioned as they'd like to be, that could very easily be a driver for another leg higher.
Yeah, and certainly if we get better news on trade, then you have the fuel to
Yeah.
turn this back into a sustained bull market run. I absolutely agree. But that all flies in the face of the rising recession odds, though, which are showing here on Polymarket. So 60% plus odds of recession right now. That seems high given the recent market behavior.
Yeah. I mean, I want to kind of flag kind of where we are, how we got here, and then kind of look at some of the risks and some of the opportunities. So, this is definitely a risk, right? I talked about, kind of when we bottomed in early April. That was basically because the left side tail risk have kind of been eliminated to a certain degree, or basically kind of the worst case scenarios were kind of being taken off the table. So, I think a lot of the participants in the market are still worried about, okay, one was the uncertainty factor, and then now we're facing okay, do we get a delay? Is there a mismatch in terms of what could drive this market down? So now do we start getting the uncertainty? Does that lead to, a slowing down in the real economy? Start seeing hard data catch up with the soft data? Do we start seeing unemployment rise? And I thought it was interesting because if you look at some of the economic metric models out there, they're closer to 30% odds of recession. But the poly markets, this is the betting markets, so people actually putting real money on the line. Um, they've stayed right around 50, 60%. Right now we're around 60, and it hasn't really come off when the market's been rallying. So there is this idea out there that we will start seeing kind of the hard data come off. And then does that mean do we get a growth scare? Right. And I think that's kind of one of the bearish arguments right now is that we will. So that's kind of where we are in terms of, another potential risk or another leg down would be coming from kind of that growth scare. And you don't necessarily need to actually go into recession. I always talk about 2022. And at the lows in 2022, kind of which coincided with that LDI crisis in the UK, the models were calling for an 80% chance for recession in the next 6 months. We didn't get it, but the markets are pricing that in. So if the markets even just start to price in more aggressively recession, you can start to get, kind of the equity start to come under pressure. So I think that's real risk here is that, over the next few weeks, we're going to start seeing that hard data start to catch down with the soft data, the sentiment data. And that's the big question for the markets. And I think that's why, a lot of people have kind of called this, one of the most hated rallies we've ever seen in the stock market, because I think so many people are worried about this potential, catching down from the hard data and a potential growth scare at a minimum from, all that's transpired in the first quarter of the year, kind of actually turning into an actual slowdown in the economy.
Yeah, I mean, it's certainly the data doesn't give you much clarity right now. It's pre-tariff, so it's backward looking. Even though we got a negative GDP number, it was all trade. It was all rushing to bring imports into the country to beat tariffs. In fact, if you take that out, the GDP number was pretty strong. Actually, I think what you saw the intraday rally last week after the market digested those numbers. I think the annualized increase in capital investment was 22% in that report. The consumer spending number, I think, was 1.8%. Those are solid numbers. I guess home building, if you add home building to those other two big pieces, I think you get closer to three. So really solid GDP report. This economy is doing just fine, which tells you that a lot of these recession odds are tariff related.
Yeah, I think that's fair. Listen, we haven't really dealt with these level of tariffs in 100 years. So I think, the markets there's just that uncertainty factor. And, the administration says uncertainty won't cause a slowdown. Others believe that eventually this translates, corporate CEOs not being able to make decisions they do they start, making cuts on the jobs front, those types of things. Is that what we're going to be dealing with kind of over the next, call it 6 months? And that's really kind of where markets are a bit of a standstill in terms of, are we going to get that growth scare from what happened in the past? And that's kind of the tough question I think markets are facing right now.
Yeah, it's one of the biggest rallies on peak uncertainty that I've seen in my career. But we'll take it. So I didn't put the regular S&P chart in here because I knew we had the S&P in euros.
Yep.
So Christian, is this trying to show what European investors are experiencing if they're buying the S&P?
Yeah, talking about, these two charts are kind of the risks. I think the other big risk for the market is just this whole idea of de-dollarization of an unwind of U.S. exceptionalism. And, we tend to be very focused on what the S&P is doing. But like I mentioned earlier, the DAX has been screaming, up 26% in euro terms, basically about to make a new all-time high. And we've talked about this, but basically, depending how you look at it with cash plus derivatives, foreign investors own somewhere between 20 and 30% of the U.S. equity market. And after that first quarter performance, I think they've started to say to themselves, okay, we got a little bit overweight US, underweight our domestic benchmark, so we need to get a little bit back more in line. I think that's kind of what we've been seeing. We've done some work on it, and there's probably, you look at your average European real money investor, so institutional investor, they're probably holding somewhere around a 10% net overweight to US, underweight to their benchmark at home. And I want to put this chart up so put yourself in the shoes of a German pension fund manager in Frankfurt. This is your biggest position, is this S&P in euro terms, because the fact of the matter is, U.S. exceptionalism was the only trade in town for about a decade, and really over the last 5 years. And as that was the case, hedge ratios started to come down because the dollar was so strong. So, essentially, the norm would be to hedge the currency to take that aspect out. And over the last 5 years in particular, we started to see that kind of drop to 20% or less on average. So, looking at a chart like the S&P, yes, we've had a big rally, but in euro terms, you're talking about something that's closer to 13% off the lows. You can see on this chart here, it's not as strong from a technical perspective as kind of that NDX chart we showed, which is already back up against the 200-day, threatening some major levels. This basically is just, back to where we broke down from. And again, a 13% rally versus an 18% rally in the S&P. So, that's the concern here, is that, foreigners were such big buyers, particularly over the last year. I've talked about how, the S&P was up roughly, 25% last year. 21 percentage points of that came in the overnight session. So you can attribute a lot of that to foreign investors buying of U.S. equities, and then they were doing it quite aggressively, cresting last year. So, after things like the DeepSeek announcement, after things like the German election, where you got the constitutional changes to be able to implement more fiscal, people got more positive on Europe. And we're in a situation where if you have less money kind of chasing the US, can it be as strong as it was perhaps in the past, where that was probably the primary driver? So that's the question mark. If they start to go back a little bit towards bench, they start selling US equities, roughly, call it, if the Europeans were to, take down their benchmarks by, go 5% back towards bench, you're talking about roughly $1 trillion in US equity selling. So, I think that's a risk. I mean, I do think there's a lot of, a lot of the headlines have sensationalized what's going on. They talk about this kind of hate selling of U.S. assets. I don't think that's really what this is. This is just people that got a little bit overweight versus their benchmark coming back more in line. We're not talking about them going to 50% underweight their bench or things like that. It's just a normal kind of rebalancing exercise. But you have to understand, these types of investors move at a glacial pace. They move very slow. They're probably, some of them are just having their investment committee meetings now talking about this. So this is a factor or a variable that could be weighing on the market for quite some time, as this money doesn't move as fast as say hedge fund money or what have you. So just something to be thinking about in terms of the S&P, in terms of U.S. equities. This could be kind of an overhanging factor for the next several quarters, very easily.
Yeah, a lot of folks chase the winners, and no doubt the international equity markets have done better this year. So even you're seeing U.S. investors shift from U.S. assets to international assets, while these folks in Europe are considering paring back. That combined with the fact that we're at a technical crossroads here on U.S. equities, especially the S&P 500, as we near that 5,700 level of technical resistance. Good chance that we pull back a little bit here.
Yeah. Yeah, and I would even argue, if you look at what's going on in the DAX right now, say you're an institutional investor trying to get back towards bench, when you're in an up market and up tape like we've been the last 3 weeks, it probably makes more sense that they're focused on getting back in line on in terms of where they're underweight, right? Which I think helps explain why the DAX has been doing so well or why European indices have been doing so well. It's that, in an up market, you're underweight your regional benchmark or what have you, and you're probably chasing that more, trying to get that in line. And then, you start getting in a down tape, then where your overweight starts to matter more. So I think there's a component to this that's, the legging in, legging out of it, trying to get that back towards benchmark, which I think we have to kind of think through as well as a potential kind of factor that could exacerbate up markets and down markets in different ways.
Yeah, and we're talking about that very thing in our investment committee meetings about regional exposures and where are we underweight, where do we maybe want to think about taking that off.
Yeah.
So that actually, I'm referring to emerging markets, which is a nice segue to this chart. Uh, China's been doing quite well. There's this whole narrative out there. I'm talking about the markets, not necessarily the economy, but the Chinese stock market's done quite well. There's a narrative that, as companies move their manufacturing out of China to avoid tariffs, they might end up in, for example, Vietnam or Mexico, and that could be very bullish for those economies. So it's possible those economies could end up better off because of the whole trade war tariffs thing than they were before. How's that strike you, Christian?
Yeah, I agree. I mean, I want to show this chart to say I think there is some opportunity here with emerging markets ex China.
Mhm.
Um, for the simple reason that, I really want to highlight first with this chart, the red line is MSCI China, and that's the biggest component within the emerging market index. And that's been what's driving it, and a lot of that came after the DeepSeek news. Then when markets got hit in April, it got hit pretty hard too, but it's still clearly leading. And then kind of some of these other countries, so call it Taiwan, which you talked about, South Korea, to an extent, countries like Mex and Brazil. They've done okay this year, but they probably haven't done as well as you thought they would have, given this whole de-dollarization narrative that's kind of taken hold after, the start of the year. And I think a lot of that has to do with the fact that, quite simply, these countries are considered kind of levered or exposed to China, and as kind of the trade tensions with China have ratcheted up, they've kind of been casualties of that. So, I was thinking in terms of an opportunity. Well, we live in a world where there's a lot of pathways we can take, right? So it's interesting when you have kind of an idea or a thesis that could do well in a few different scenarios, right? And I think that is EMX China, because if we get any sort of meaningful, uh, you know, detente with respect to China on trade, these countries should do well, right? Because they would be clear beneficiaries because they've kind of been penalized for their exposure to China. So again, if we start seeing kind of trade go in a more positive direction, these countries could do okay. I think, if this de-dollarization theme continues, so this kind of glacial pace of money moving outside of the U.S. looking for opportunities, in international equity markets, they could do very well too, because they haven't done as well, and these markets just there aren't that many places to go that are liquid enough to be able to accept large pools of capital. So I think, in a scenario where we get kind of this multi-quarter de-dollarization theme play out, a lot of these countries are arguably quite cheap. Uh, And another way would be if what the administration in the U.S. is doing is actually works, right? So this whole idea of regional reshoring, well, in that type of world, I could see Mexico and Brazil doing quite well. And we've talked about Brazil quite a bit. At the index level, you're talking about an 8% dividend yield, trading at single digit multiples. So there's a lot of value to unlock if we were to go into a scenario where this regional reshoring is happening, and I can see those markets doing quite well. So just wanted to point out there's a few ways where kind of EM ex China can perform this year, and it's not relying on one specific thing happening. There's kind of a few different pathways that it could find ways to perform in.
Yeah, and certainly the better performance of Latin America lately has, I think, reflected some of that. So yeah, China's a big chunk of EM, but it's not quite half. So you've got actually more non-China EM in the benchmark than you have China. Although we recognize, of course, that some of those Southeast Asian nations are dependent on China's economy. So there's, of course, economic spillover, but still the non-China EM index is, a pretty big chunk of that. So really, really great insight there, Christian. So we'll be watching that. I mean, EM's still cheap too, by the way. So a lot of these markets, they aren't trading like they are going to be a big recipient and end up better off than they were a few months ago. So keep that in mind. All right, let's switch gears and we'll listen to the equity guy talk a little bit about bonds. You'll have to help me out here, Christian. But don't worry, people, because I am going to read some snippets out of Lawrence Gillum's weekly market commentary this week, which you can find on LPL.com, which is about municipal bonds. And I'm only going to give you the stuff that I really understand. So trust me, this won't be that painful. So first, municipal bond yields are attractive versus history. So for the muni bond index, your yield's in the fours, but if you add the tax benefit, you actually get to around 7, right? If you're in the highest tax bracket here, we assumed a tax rate of 40.8%. So that is a very attractive yield, certainly a high hurdle to think that equities would do better than that. A very attractive yield. Munis are cheap because they've been getting hit by several things. So obviously the treasury market has been weakening a little bit lately and been volatile lately. So that's spilled over. The Fed kind of locked into higher for longer is part of this. Less foreign demand. There's that theme again, Christian. Less foreign demand for munis. Some folks have gone to cash to avoid the potential losses in the bond market if rates rise. There's a number of factors. There's hedge fund deleveraging. That just came from you, Christian, in that theme. And then illiquidity. There's that word again. So all those things together have weighed on the muni market and created this attractive opportunity in terms of valuations. Another headwind has been issuance. So this chart shows you the path of issuance this year. So this is supply, right? So if you have more supply, the supply and demand balance tends to lead to lower prices, which is higher yields. So here you see the path of issuance is ahead of 2024, and 2024 was a record year for muni issuance. I actually have the number here, 18%. We are tracking 18% ahead of last year's issuance year to date, and last year was a record. So there is a lot of supply out there that, again, has created a cheap muni sector that therefore has made what we think is pretty attractive opportunity. So we like munis. The fundamentals of munis are better than corporates, at least measured by default rates. So here I have another stat for you. Since 1970, 10-year cumulative default rates for investment grade munis barely above 0. So hardly ever default. For similarly rated corporates, the rate is about 2%. So you get a better default profile when you're in munis versus corporates, even in high grade. And then if you look at high yield munis versus high yield corporates, the default rate is 75% less in munis. So just a better credit profile. So you have better fundamentals, very attractive valuations, the tax benefit. right, which gives you tax equivalent yields of 7. It's really attractive, we think, right now within the bond space. So I guess my question for you, Christian, is did any of that make sense as an equity guy talking about bonds?
It did, yeah. I mean, listen, I'm a simple guy, right? And the way I view these things, whenever you get dislocations in the market, like we had last month, investors tend to throw out babies with baby with the bathwater, right? To use that expression.
Well said, yeah.
And right, and I think what we saw in municipal bonds was exactly that, right? I mean, I noticed that we had, I like to look at closed-end funds of municipals. And we started to see, some fairly high quality closed end funds that have quality municipal paper in them, kind of trading below NAV. So you could literally buy these bonds below their intrinsic value, right? And I think that's a natural function of markets like we had, where it just becomes about de-risking volatility and being able to think through that, understand what's going on, and there's going to be opportunities here. It makes a ton of sense what we're seeing that munis are a place of opportunity right now. Probably less so than they were a few weeks ago, but kind of makes complete sense. Kind of what Lawrence is talking about, just
Mhm.
given the veracity of the move that we saw kind of in the early half of last month.
Well said. Well said. So let's move on. That's a great piece from Lawrence, and you can find it on LPL.com again. So previewing the week, it's about the Fed and earnings this week, Christian, in addition to just watching the headlines on trade, of course, which we now are getting very accustomed to, having done that pretty much all day, every day for a month. The FOMC, Powell and the Fed are really in a tough spot. So I don't know that we're going to get anything too interesting from them this week. What do you think?
Yeah, I mean the market's kind of priced out. I think we're looking July at the earliest for a cut. But I think the markets will be looking for a little bit of a shift in tone from Chairman Powell. So maybe getting a little bit more dovish or dovish inclination. I think is kind of what the main thing. So it'll be a little bit of looking at the text and trying to figure out kind of where the tonality is changing. But other than that, I don't really see much coming from this because yes, they are in a kind of a little bit of a tough spot at the moment. Um, Claims have been ticking up quite a bit recently, or a little bit to where it's worth noting. So I think that's kind of on people's radar as well, just given this whole thing we were talking about earlier of, is the hard data starting to catch down with kind of sentiments. I think that's probably one to be looking out for kind of later this week as well.
Yeah, that's a good point. 241 was the last claims number. So you've probably got maybe a little Doge creeping in there. And then just trade uncertainty, of course, which is probably the biggest piece that's pushed that number a little bit higher. But as we all know from Friday, the jobs report for April was just fine, better than fine, really. So, job market is clearly cooled. We can all agree on that. But maybe you have a little bit more cooling yet to come. I think the other big story this week is the earnings, and the numbers have been really good. The Probably the best news for me is that the hyperscalers, the big tech companies, have maintained CapEx guidance. The capital investment on AI for that group is still growing at 30% plus. That is a huge number. Um, so even if you don't get a lot of capital investment from the rest of the S&P 500, those numbers are just so big that they can really drive earnings higher. In fact, I think half of the earnings growth this quarter in Q1 has come from the big tech names. And you only need 6 of them because Tesla didn't grow earnings. So we'll call it the Super Six. Half of the 12% or so of earnings growth in the S&P has come from those names. So they are really important in driving earnings, driving capital investment, and keeping this S&P 500 index supported because they're just such a big piece of it. So we'll be watching for more on CapEx from other companies. Certainly that's important. But otherwise, I would just say we're not getting a lot of information because a lot of the guidance has been sort of conditional. We're getting guidance from I'd say a surprising number of companies, but a lot of it is, you know, either without tariffs in it, or they give, you know, one outlook with tariffs, one outlook without tariffs, and they're wide ranges. So I just am not sure how hopeful that is, and I think it's delaying the process of getting estimates down to where the market can believe them. So frankly, I mean, we really just don't know if we're going to get 260 in S&P 500 earnings this year or 250. Heck, we could get more than 260. It's just really difficult to say when tariffs are so meaningful. So, Christian, thoughts on earnings?
Yeah, I mean, listen, I think what we've gotten, particularly from some of the Mag 6 names, has been very positive, right? Kind of, I echo your thoughts on the CapEx and kind of this whole AI narrative kind of remaining strong. I think it's somewhere around 50%, maybe a little less, had actually given of the companies that report have given guidance. But given where we were a few weeks ago, I take it, right? It's been
Me
stronger
too.
than I think we would have expected. And I think that's been, like you said, part of the driver of this kind of historical rally we've been seeing in stocks the last few weeks. It's that anytime you kind of have the market expecting something a little bit more dire, and you get something kind of coming in above those expectations, it's gonna help things, and we're certainly seeing that. So I just want to see
Mhm.
it continuing.
Oh yeah, earnings is an expectation game, no
Yep.
doubt. All right, very good. So with that, we'll go ahead and wrap. So thanks, Christian, for all those great insights. Really, some interesting charts that I think when you put them all together, you've got a market that may have a little bit of a struggle here, making another move higher, but certainly so much is dependent on trade that we're really just going to have to wait and see. So hopefully we'll have more answers for you next week. Hopefully we'll get some trade deals over the next few days, which the White House has been signaling. We will see. So thank you for listening to another LPL Market Signals. Really appreciate it. Everybody have a great week, and we'll see you next time. Take care.
See you later.